welcome to another episode of Test, Optimize, and Scale. Very excited to have Jonny Price from Wefunder here with us today, one of the top portals in investment crowdfunding.
Hello, hello.
And have had the opportunity to do a webinar in the past with Jonny, have him on the podcast here today to share all the insights, and excited to hear more about the story. Wefunder's seen tremendous growth and has been in the #1 spot in the past couple months on King's Crowd. So excited to get all the details.
Yeah, absolutely, man.
And just looking at your investor base, you guys are over 850,000 investors today, drastically more than January 2020. What's been the story there? How have things been evolving?
Yeah, so we've seen a tremendous amount of growth over the course of 2020. I think that generally speaking, what you find with all crowdfunding platforms is that if you launch more companies and better companies, then the investors follow. So when, for example, we launched Lost Spirits, which is a distillery in LA, if you haven't been there, by the way, Jason, go check it out. We can probably get you a discount as a Wefunder partner. We know their team well. And so they raised like $1 million in a couple of days from sending one email blast to their customer base, right? And so, when you have great founders and more founders raising capital on the platform, as happened in 2020, then they recruit the investors from their customer base, from their marketing. And then those investors, obviously now users on the Wefunder platform, we can then remarket other campaigns to them as we do, together. So I think, driven by probably the pandemic, which meant that it was harder for founders to raise capital, especially early or Q2 2020. So then a lot of founders were coming to Wefunder to help them raise capital. And then also we made a really important product change early in 2020, where we rolled up individual investors to one line on the cap table, which is just a game changer for founders and their willingness to raise capital through regulation crowdfunding. So a combination of those two things, I think, were the two biggest drivers for our growth. We also brought some great new people onto the team, great founder in residence, Pod, who's raised $500,000 himself on Wefunder. Justin, myself, Mark down in LA, working in the F&B sector. So our team is, grown, and the tenure on our team is there. We've kind of retained key people, and so we've also kind of built out the engineering team. So put a lot of things together, and we've seen a lot of growth in investment volume through 2021. Q4 was 4.3x up on Q4 2019 for us. So coming into 2021, really strong momentum, and then obviously, we'll probably get into this, but the rule changes that the SEC announced, they announced it in November 2nd. It's going to be rolled out and implemented March 15th. We expect that to accelerate the growth even more, both on the founder side and the investor side. So very, very exciting times for Wefunder and RegCF more broadly.
Love it. I've been a fan of the product, the team as well, too. I guess we didn't go too far back in the storyline, but Justin Renfro, I believe Susanna and other team members came from Kiva, and you guys have continued to progress from here.
Yeah, absolutely. I'm from the UK originally, but moved to San Francisco in 2010 because I was dating an American girl. But then I joined Kiva.org, a nonprofit based in San Francisco. I lived in SF for 10 years, and I came to Kiva to launch the US team back in 2011. And just me at the time, and then we grew it to probably all in about 50 people working on it throughout the country, and made 5,000 microloans to US entrepreneurs during those 7 years. And so Susanna was basically running our operations, and Justin was running growth on the Kiva U.S. team. And so then when I left to join Wefunder in early 2018, I managed to get Susanna to join Wefunder soon after, and then Justin joined a year or so later. So now we've got the triumvirate of Kiva continuing to hopefully drive good growth at Wefunder as well.
And it impresses me how you're able to provide that personal touch, that white glove service throughout the process. I'll hear Justin's recommendations from issuers all the way through. I know he's got his playbook there and all types of marketing recommendations to leverage first degree connections and continue to have distribution of content throughout the campaign. It seems like you guys are very, sleeves rolled up throughout the entire raise.
Yeah, I think so. I mean, if a founder raises $1 million on Wefunder, they might pay us tens of thousands of dollars, right? And so I feel like we need to be worth that. And so part of that is being available to jump on a call, to brainstorm on fundraising strategies, or give them feedback on their campaign page to make sure that it's super polished and puts their best foot forward to investors, or working with them on the nitty-gritty details of their financials and Form C filing. So we have a bunch of people on the team. We try to have specialists in different areas. So you have an account manager that works on the legal disclosures and the financials. You have a storyteller that works on your campaign page. You have a fundraising coach that works on the fundraising strategy and execution. You have someone that works on closing and financial operations. I'm usually more involved at the outset of the process, kind of setting expectations up front and trying to ensure there's a good alignment going into the campaign. So we with the amount of money that founders are paying us, we need to be worth it. And so we try to be hands-on and be a resource. At the same time, we also want to be building out the product and building out kind of automation and self-serve so that founders can get the information they need immediately themselves without having to schedule a call on our calendars. So it's a little bit of both, but yeah, we generally are spending obviously many hours working with founders, holding their hands throughout the process.
And being at the front line of communications with an entrepreneur before they even go into their Reg CF filing, what are the questions that you're getting asked on whether this is the right route for them to go down? And how are you seeing those answers change over the past year as investment crowdfunding is becoming more and more popular?
Yeah, I maybe put that a little bit different of kind of why would a founder do Reg CF? And so I think for me, there are kind of two main reasons, right? One is making it easier to raise capital. So, being able to publicly promote the offering, being able to raise from unaccredited investors, being able to get in front of those 850,000 Wefunder investors who typically bring about a third of capital to campaigns, roughly, for an average campaign, can be more. So, for example, Y Combinator companies, we've launched a bunch of YC alumni on Wefunder, and for them, it's more like 70% of capital is coming from Wefunder's existing investor base. So, or if you have a growth chart that's up and to the right, that's going to get a lot of interest from Wefunder investors, and so you might raise more from them. But on average, is the third. But just being able to get in front of those investors that previously you had no access to, and they have Wefunder accounts, and they're browsing our emails, and they're looking at our explore page. It makes fundraising easier. So that's one piece. And obviously now with the SEC rule changes being rolled out in a couple of months, being able to raise $5 million versus 1.07 million, which is previously the limit, that just makes it more attractive for more companies, right? And there's certainly a fixed time investment on launching a Reg CF campaign. So doing the financials, the legal stuff, etc. Although even that's being reduced now with the testing the waters rule changes. But for that fixed cost now of paying a CPA to do a review of your financials, you can now raise 5 million versus 1.07 million. So I think that's just going to make it even easier for more founders to raise more money. And then the other big value proposition, as is on the marketing and kind of customer engagement side. So especially if you're B2C, but I think also if you're B2B, right? If you're selling to enterprise customers or restaurants, then if you can have those restaurant owners own a piece of your company, they might be more loyal customers for your app. As well as obviously if you have a consumer-facing business, then if you can recruit those consumers or generate new customers through having them be investors in the company, then that can do really good things for customer acquisition and retention. So that is then the second big value proposition is like building an army of brand ambassadors and customers and champions. And I think, like, to your question on how this has evolved, I think one question that's come up in the past, and it still does come up, is maybe kind of stigma. So like a negative stigma around raising money on investment crowdfunding versus like a VC, you know, or the angel REITs. I don't know why I put VC in quotes then. But anyway, I think, you know, that has been largely mitigated now by being able to roll investors to one line on the cap table. I think really takes care of that for the most part. And then there probably still is some snootiness in some circles, but I think that's just going to dissipate more and more over time with, you know, more companies choosing to go this route with the law changes that just went live, more success stories. And, you know, if there really is value in that second point, right? If as a consumer-facing startup, if you can recruit 1,000 like super loyal champions and supporters as owners of the company, and if that really does do good things for your growth, then you'd almost have to be insane not to, you know, to see this as any sort of detriment to, you know, kind of raising follow-on financing.
100%. And even in the snooty circles, and I think I know some of the groups you're talking about, I've seen the perception change over the years here.
Right.
And because of the numbers, they speak loudly. I'll go back to King's Crowd and the analytics that are visible on a monthly basis, on a weekly basis there, and you're able to get a sense of what's occurring. And, you know, being able to use a portal, having over 850,000 investors, like you said, that first point, that's huge. You know, looking at, let's say on a Reg A plus or Reg deal or some Reg D deal where some issuers will take to their own site, they don't have that other working element. There's no email newsletter or premium placement on the site that's tapping into those other large investor pools throughout the process. And that third is coming through. Being able to look at the expansion to 5 million, and I want to get into that further, again, becomes more and more attractive to different groups in the VC community. And looking at the ambassadors, looking at user owners, I really paint that as the new premium audience, because you look at, I don't know, 1,000 investors at $1,000 average each, roughly, for 1.07 million, even further. They're connected to the brand at that point. They're sharing with their friends and family. They may be frequenting the business themselves, whether it's B2B, B2C. So where some groups said, no, we only want accredited investors or high net worth. I said, yeah, that's great. And there's a lot of benefits to that, but check out what these groups are doing by bringing on high volumes. And I look at on Wefunder, the Legion M's, where, you know, they're going after a pool of 1 million investors over time, and, you know, have these huge numbers. And there's over 10,000 investors that have given their name and reviewed.
I think it's coming up on 30,000 now.
Well, yeah, and I was just mentioning the reviews, like they're physically listing.
Oh, got it. Yeah.
You know, and promoting behind it. I mean, that's true ambassadorship. So I've been quoted trying to talk about how that is the audience you want to be going after, and there's this whole marketing value that takes place throughout the process of the raise.
I interviewed them for our podcast, our venture capital podcast. It's something that might be, if you're interested in this aspect of crowdfunding, i.e. recruiting a community, recruiting an audience of champions and ambassadors, that hour-long interview is one of the favorites I've done. And they really go into great detail about how for them, this isn't just a capital raising strategy, and they've now raised more than 10 million on Wefunder through Reg A and Reg CF. But it's also a way for them to just build a community, and, you know, they're getting tremendous value now out of having recruited these coming up on 30,000 investors in the company through Wefunder. So it's a really cool interview. I think it's called Democratizing Hollywood on an Adventure Capital podcast. Yeah,
definitely gonna have my team check it out after this as well here too.
Put it in the show notes, Jason. The old show notes that no one ever reads. Does anyone ever read show notes?
We'll get it in there. We'll let you know the link clicks that we get on.
Yeah, there we go. Track everything. Track everything.
Track everything is a true statement.
Even track the show notes.
Always be tracking. So yeah, and being able to build up that audience, being able to look at it as a marketing utility. As an agency, we'll get asked by issuers at times to run in addition to their investor acquisition campaign, a customer acquisition campaign, sometimes simultaneously. At other points, post.
Well, that's awesome, right? When you can combine the two, because you know as well as I do, founders are always looking at ROAS, right? Like, what's the return on ad spend, investment volume to ad spend. If you can sign up a customer as well as an investor with that, then the economics and the math just like really improves, right? If it's not just a 5-to-1 ratio of investment volume to ad spend, but also that dollar of ad spend drove $5 investment, but also $20 of revenue at a 60% gross margin, then all of a sudden, like, the economics can look amazing here.
Yes, and the investor acquisition economics are looking stronger and stronger. We've had friends of friends talk to us about a customer acquisition campaign, see what we're doing in investor acquisition, and then they're saying, wow, we need to do this for ourselves. We're shooting for a 3x on e-commerce to go after 10x type metrics for capital, and being able to set everything around the valuation is really appealing to them.
Absolutely, and you can set up like funnels both way, right? So if customers, then maybe you can kind of drip them an investor email series, and investors vice versa, like trying to sign them up as customers.
Yes, it could be email 4 of a customer acquisition drip, where now they have the opportunity to participate, be an ambassador, be directly benefiting as the company grows in the coming years, and be early stage at that value at that. So,
and I think this is maybe jumping ahead in the conversation, but I think like where companies, consumer facing especially companies, can really play into that, right? It's like as they're trying to sell you on like becoming their customer, if they can also really like double down on, and we're building a movement here where our customers are actually owners of the company. I'm a pretty mission driven person, but I think early stage brands, it's how do you cultivate community? How do you cultivate that kind of distinctiveness versus other competitors? And that aspect of, we're welcoming our community and customers in to be owners of the company, and we welcome your feedback on like how we can improve the product, or what geographies we should go into next, or whatever else it is. It actually kind of can strengthen the relationship, I think, between the brand or the company and the customer.
Definitely. And I'm always looking for brands that are new, different, mission-based as well. Not on every purchase of mine, but things that are new and different. So if I was also getting involved at an early stage of that organization as a consumer / investor, that's huge. The first time I learned about equity crowdfunding, the example of Oculus was presented to me, where they did a crowdfunding campaign, reward-based.
Kickstarter,
6 months later, they're acquired, by Facebook, over $1 billion, and the backers felt like they played a role in that, and if they had a piece of equity, they would have.
Oh man, imagine that would have been awesome if that like created so much wealth for the backers. If they'd had shares in the company as opposed to just getting a product, that would have created a lot of wealth. That would have been really cool.
And I envision a world in the future where we're owners in every type of brand that we back, and as they do more good things, as their growth occurs, everyone benefits. Not to get too philosophical, but I know that's what's happening with a lot of these issuers, and going after the user owner targets there, and especially at larger amounts here. You mentioned test the waters, and at the theme of the show of test, optimize, scale. What recommendations are you giving issuers for marketing channels, for their offering page, overall things they should test for test the waters leading into these next round of campaigns that could ultimately raise at 5 million?
Yeah, so obviously testing the waters doesn't go live until March 15th. So legally, from a compliance perspective, companies are kind of constrained for the next couple of months or so. But I think, this is a really exciting aspect of the new regs, right? The 5 million cap is probably the headline, and there's some other cool things as well. So, for example, right now, accredited investors can invest an unlimited amount in Reg D but they are limited to investing 107K per year in Reg CF, which makes literally zero sense, because there's actually more disclosure requirements for Reg CF than Reg D. So, harmonizing investor limits and for anyone being able to invest the maximum of income and wealth versus the minimum. So there's some other good things as well. But yeah, testing the waters is an important thing and of the new regs. And so basically what this does is right now, you can't publicly talk about your intent to run or like an upcoming regulation crowdfunding campaign without filing a Form C. And filing a Form C is like, we've tried to streamline it as much as possible, but if you're raising more than 250K, you need an independent CPA to review your financials, and there's a cost there and a time investment. And so it just means that, it ends up taking a few weeks to file a Form C and formally be able to, launch a campaign and publicly promote your offering. And we're testing the waters now before you file the Form C, i.e. before you incur that time investment, cost investment, CPA fee. You can immediately start promoting about the raise on Facebook, in an email to customers or friends and family or LinkedIn or wherever. And so this is just going to, significantly lower the barrier to entry, I think, to companies launching a campaign on Wefunder and starting to hit up their network. And to the question and the idea of, as the name implies, testing the waters, I think like rather than kind of risking or like going into it as a bit of a leap of faith, now companies can really reach out to potential investors, like get the ball rolling on the campaign in this kind of like testing or like pre-launch mode, and then only when they've kind of validated that there is demand from investors, then go ahead and take the time and investment to file the Form C and launch the campaign. So in terms of like particular tactics during that testing the waters phase, I mean, I think like it's still pretty early days, so it'll be interesting to see the different things that work. I still think like if I was running a campaign at that stage, I would still be more what's the word, kind of personalized in my outreach. So I always think like this is kind of, maybe this is because I'm getting on in my years now. I'm just like a dinosaur in many ways probably, but if I was running a Wefunder campaign, I just get like a spreadsheet of like a couple of hundred people that I've worked with at Kiva or Oliver Wyman or a Wefunder, or like friends from college or family members, whatever it is. Just get a long list of people that I think will believe in me and want to support me, and just hit them up one by one. And so personalized outreach, and it's definitely grind, it's labor intensive. It's certainly not kind of super scalable. But for me, like the first like weeks of a crowdfunding campaign, like a Wefunder campaign, that's honestly the best, along with like reaching out to investors and trying to raise larger checks. That kind of personalized outreach is a very high ROI strategy, and then that builds the momentum on the campaign and puts like dollars in the campaign and investors in the campaign. And then whatever more mass outreach you do, or paid marketing, is going to have a higher conversion rate, because you've already closed the money from people that kind of believe in you and know you a little bit better, and so they're willing to be the first money in, probably more so than someone that sees a Facebook ad or receives a marketing email from Wefunder.
Yeah, and I think back towards fundamental reward crowdfunding tactics, where you really have to do the whole, if you do a third of the raise in the first day, you're on path to hit your goal in 30 days. So smaller time window, but we would build audiences of 10,000. If 10,000 people submitted their email address, maybe we could get 200 of them to convert on day one. And then things snowball and snowball from there. And we've been doing test the waters on Reg A Plus campaigns.
Right.
And, there is a percentage of reservations that end up turning into a completed investment. Some of that's at smaller increments. Others just don't respond. So it still has its own obstacles with it. but being able to audience build at the early
Right.
stages, being able to really tap into those first degree connections. I know Justin recommends 200 or more, and to really, you know, go out of your way to look at your personal and business networks. And I've seen amazing things occur there from founders who, you know, had their reservations about going after their audience. They said, we've already tapped into everybody. And then looking at different messaging sequences, we're actually able to get not just backing at any level, because the count of the investors has such a large, it says something so loudly, but also the social sharing, where an investor shared it, and then someone they knew or someone in the industry, and they're able to bring a strategic connection together. But you know,
I think, I think that's right. One tangible example of that, and actually also on that point, like if you as a founder can't persuade people that you know well to invest in you, right? And people say, I'm tapped out, but then it's like, well, presumably you're tapped out through kind of, you know, normal fundraising. This is a way of like, it's online, you can easily share it, unaccredited investors can invest. So like, it's very rare that, you know, founders truly tapped out of like their own network when they launch a Wefunder campaign. So then it's like, you know, if you can't persuade people that know you to invest in you, it's going to be pretty tricky to persuade strangers to do that. But the one tangible example I was going to give was this guy, Renji Bajoy, who's the CEO of Immersed, who ran a very successful campaign on Wefunder last year, raised $2 million in, I think, a couple of weeks or so. 1.07 million in Reg CF, and then another million in Reg D on top of that from accredited investors. But he told me on our podcast, another really fascinating interview. Would highly recommend people check that out. But he told me that he had this like core team of I think he said 35 people, and they were his people. And so every time he would post an update on the campaign, he would have those 35 people immediately share the Facebook post or share the LinkedIn post, or like, you know, whatever he needed doing, these 35 people were his people, and they would help him to do that. And that was a brilliant idea that I honestly don't think I've heard other people talking about in the past. I don't know if you've had experience with that with the campaigns you've run, but that's awesome, right? Because then you just get so much more leverage. The whole principle of crowdfunding, if it's not just you doing the work, but, you know, in his case, if you get these 35 like core team to immediately share it, and then even better, if you can get the 1,000 investors to share it, because they're investors in the company now, so they want you to fundraise as quickly as possible so you can get back to running the business and making them a return on their investment. So they're incentivized to help you succeed in the fundraise. So now how do you build the relationship with them through the fundraise? How do you get them excited? And ultimately, how do you you know, put them to work for you to help you accelerate the fundraise by sharing that social media post, or by like telling a few people that they know to come and check it out. And so that kind of leverage, if you can get that going, I think that can be very, very powerful.
Oh yeah, you're getting social proof. People generally don't believe what they see on the internet. So if there's 75 or more people saying this is great, if some of them are industry experts or just very visible investors to some degree, that says something even further. Not to mention the social algorithms. So if that's LinkedIn, if that's Facebook, the algorithm rewards that, and it starts going to their audience. Hey, look to what so-and-so just commented on, and continue to show up higher and higher in the feed.
That's what Renji said, you know, like the algorithms, I think they're probably pretty sensitive. So if you have a post and then 35 people share it immediately, that's really going to give it some juice in that LinkedIn algorithm. I've noticed this, it's anecdotal, but I mean, I've noticed this myself as well. I don't understand how the LinkedIn algorithms work, but if I do a post on LinkedIn and it gets early traction, then boom, it really blows up. So yeah, that's a good point. It's like then with the social media algorithms, if you can have that crack team of 35 people kind of really helping to promote content as soon as you do it, that's a virtuous cycle.
You're a LinkedIn influencer. I get to see your feed and all the comments that are happening.
I didn't even know that.
And I
Yeah.
understand that you guys really support. So if an issuer does a post, you guys will often comment or like or something like that, just to add to that momentum.
Yeah, absolutely.
Which I think is huge. We're getting asked more and more about that. We're encouraging founders to do the same, not just with us, not just with portals, but with all the different groups involved, and get them sharing, get them commenting.
100%. That's another very powerful tactic, I think, right? Is if you have if you went through an accelerator, that accelerator both has a relationship with you, and so they want to help you just because of that. But also, if you run a successful raise, then that's good for their portfolio, right? And their like long-term metrics and growth and success. So they're pretty incentivized to help you. So maybe they can write a tweet about your Wefunder campaign, or include you in the email that goes out to their alumni or investors in the network. But so with accelerators or with other groups or organizations that you've worked with, maybe it's your alma mater, a college newsletter, but trying to find these groups that have a relationship with you, want to help you, and have an audience that they can put you in front of. And if there's an affinity with that audience, so if like other Techstars founders, see, oh, this Techstars company is running an equity crowdfunding campaign, they're probably going to be quite interested to check it out. So there's an affinity there, as well as the audience. So that's another powerful tactic, I think.
And different types of content as well too. I like to reference Jeremy Barnett, CEO of Rad Intelligence, about a successful raise on your portal, and he had a Zoom video call that was run as content. We ran it as ads, 4 quarters to the screen. CEO, their initial angel investor, the head of Expert Dojo, Brian McMahon, LA-based accelerator, and with Startup Camp as well too, who promoted to their investor group. So talk about that third-party validation, talk about the engagement, and I'm seeing more and more formats like that, not high production value, but very authentic.
And I think that's right. Authenticity and I think depth is trumps glossy high production value image, right? Because if I'm going to invest $1,000 in this company, I need more than just like a nice infographic, right? So if I have a video of the founder like answering hard questions from smart investors for 30 minutes, and I can really see, wow, like this guy is formidable, to use a YC word. This guy will run through walls. This guy will make things happen. Like he is a master of his space. Wow, like I would invest in that guy. I think that is brilliant content. We started doing expert interview panels on Wefunder where we have, maybe it's a partner from Y Combinator, or maybe it's an expert angel investor in the sector, so with deep sector expertise, so they can ask really hard probing questions and really go deeper. So I think that kind of content is excellent. And then the updates are obviously very important as well. Yes. Those can be updates, but I think too often founders are like, we passed this milestone, we passed another milestone, and sure, like I guess maybe, but the best updates, I think, right, are like, hey, we just like closed our revenue for the month, and January 2021 saw like biggest ever month, 40% month over month on December. Here's the metrics up and to the right. Those are or like, hey, we just got featured in the New York Times, or or we just hired this awesome software engineer from Stanford PhD. Or like, so if you have these really exciting company updates, that's what investors want to invest in, right? More so, it's the same point as you mentioned with like maybe low production value content. It's like investors aren't investing in the gloss or the superficiality. They're investing in like underneath, like, is this a good company? And so having those updates be, these are really exciting developments with the company, more so than like we hit another milestone on Wefunder, I think is better content.
Yeah, as you're saying, the numbers and being able to show the momentum that's occurring, the third party validation, and the people involved. Let them, be able to have that type of connection with the individuals. And we'll put together content calendars determining what's going to be posted where and when, with social, email, all the different channels, and try to write it as if it's a script. And like, hey, would we stop paying attention halfway through the storyline? You can't just say, how about now each time, or we hit this level. There has to be some further depth to it. What about advertising and how it's all incorporated? What type of tests do you guys recommend for ads to an issuer? What should they anticipate? I know it can be a top channel for groups. Obviously, if it could be done organically and the paid media budgets aren't required, that's a good thing. But even if it's just for retargeting and bringing people back who have been to the page, we found it to be consistently valuable. What are you guys stating towards ads these days?
Yeah, I think it really depends, right? So yeah, the ideal is obviously the Lost Spirits example, where they have such a huge audience and it's like such a compelling investment opportunity that they raise $1 million with no ad spend in a couple of days, right? So that's obviously like the ideal, right? Dreamland. And then on the other hand, you've got like a company that just no one wants to invest in, right? And so they like can't pay people to invest in it, right? And so then it's like you might spend like $500,000 on ads to raise $1 million in capital, which is just absolutely horrendous like thing to do. This is bad for everyone. I think about, if you build it, they will come, and like the balance between product and marketing, which we normally apply to a company selling its product, right? So if you have an amazing product, obviously, hopefully, if you build it, they will come, but you also probably need to do some marketing and distribution to ensure that potential customers see it. And so it's a bit of both. And even Peter Thiel, actually, in 0 to 1, who you would think would be like if you build it, they will come, all about the product guy. I was quite interested in that book. He's like, no, kind of both. So we normally apply that to like companies selling products, but I talk about that applying to investment opportunities too. So on Wefunder, so the product is basically how attractive is this investment, right? And then the marketing is like, how do we tell people about the Wefunder campaign and they can invest in it, which might be ads or it might be organic marketing, the other ways that you support the founders you work with. But so on the product side, when you launch a campaign or when you're about to launch a campaign, there's obviously limited. It's like harder for you to improve the investment opportunity, right? Because the investment opportunity is like, what's your background as a founder? Well, you can't really change that at that point, right? Like, did you have a previous exit for your last startup? You can't really change that, or like, what does the growth curve look like? Well, as a founder, hopefully you're always trying to, get growth going in the startup, but it's like harder to like, double your revenue this month just before the campaign. That you can probably play some games of that. Like I've heard of founders with raising from VCs where they juice up the marketing spend to juice up the growth, as they go into the pitch meeting kind of thing.
Sure.
But overall, like your ability to change the product, i.e. how good is this as an investment opportunity, is relatively limited. The one thing you can do is change the valuation, right? And so that is one thing that I think is key, right? What is like, founders will have a higher ROAS on ad spend if they go with a valuation of 5 million versus 8 million, right? And you wish you knew the elasticity, right? Would the ROAS double, or would it only increase by 10%? But certainly, like the lower the valuation, i.e. the more attractive you make it for investors, the more attractive your investment opportunity product becomes. So that is something that you can control, and before you launch. And I think that's something which I've seen many founders screw up, and that you've probably seen this too, and you launch with a valuation that's too high, and it's like, well, we told you in advance, like, you need to lower your valuation. This is just out of line with market, and you're the boss. Like, we're not going to babysit you. Sometimes we'll veto it if it's like absolutely crazy, but for the most part, we're pretty laissez-faire about that stuff. But then a founder might go with a valuation that's too high and struggle. So anyway, that's all on the product side. And then on the marketing side, this is where the ad spend comes in, and the other marketing tactics. But what I was getting at is, like, basically, the better the product, i.e. the better the investment opportunity, the less you need to spend on ads, right? The less you need to invest on the marketing in order to reach your goal quickly. So one example is like if Elon Musk was to launch a Wefunder campaign tomorrow, he would raise $5 million in 5 minutes, right? Just because it's Elon Musk, that is the product, that is the investment opportunity that people are investing in. And you know, if it's someone that hasn't done anything before and it's pre-launch and there's no real kind of differentiation of the product and it's a small TAM and all the other things that, and it's a high valuation and all the other things that investors are looking for in, you know, assessing whether this is a good investment opportunity product for them to buy. Like if all those things are challenging, then the ratio of like return on ad spend goes down and down and down. And so for me, it really depends on a case by case basis. And obviously, like if you're, as we were saying before, if you're a consumer facing company and you can generate revenue as well as investment volume from the ad spend, amazing, right? Then all of a sudden, like the ratio that you should be willing to pay to acquire an investor should change. You know, if you're a deep tech company and there's very little revenue benefit from bringing on investors, then you probably should have a higher bar for a ROAS threshold that you should be happy with. So I don't know, pretty long-winded rambling answer to your question, but I think like it depends is unfortunately probably the simple quick answer. And you really kind of need to get into the nuance and look at, you know, each individual company and founder, what they're trying to get out of the campaign, what assets they have, you know, and obviously, as the name of the podcast implies, and as you and I both know, obviously testing as you go, right, and testing different channels, testing different messaging, and then doubling down on what's working.
Different audiences. Yeah, messaging, personalized audiences, like you mentioned.
And the last thing, just to mention on ads as well, I guess, is that like I'm sure you've seen this as well, is that like the ROAS goes up through the campaign, right? So it goes back to the point earlier. It's like if there's already, you know, like hundreds of people invested from the founders network or their close circle or customers, then the return on ad spend will be a lot higher than if you're trying to get the juice going at the start of the campaign. So I think that's always something that's worth keeping in mind. So for me, I would try to on the spectrum between, you know, kind of paid ads and organic marketing, I would tend to skew, or like kind of hustle and like offline, like relationship based investor recruitment, I would probably skew more towards the latter earlier on in the campaign, and then kind of over time I think you'll see the ad spend having a higher return. That's obviously, you know, that's a bit of a catch-22 sometimes, because it's like, you know, well, sometimes you need to juice it in order to get the momentum building.
Yeah.
Yeah,
you got to build a large enough retargeting pool. So if you drive 50,000 people there early on and you continue retargeting them, once they hit about 7 touch points, 7x frequency, you're going to see a higher conversion rate of it. Why ads will work better generally the second, third, fourth weekend versus right out of the gate. Even if they are doing well day one, they're still going to evolve as that moves along. At least that's the common story we've seen. And then the reason why I'm such a fan of ads isn't because I like spending money with Facebook. It's because it's very scalable. If I can hit a $75 cost per acquisition, if every $75 produces a new investor, if those are coming in at a $750 AOV, average order value, that's a 10x return.
Right.
If we're able to reach more of that audience and do twice as many investors at 75 or within a 10-20% range of that the next week, where we're systematically scaling how many investors are coming through. It's like you said, there's different points of the campaign that culminate. The end of the campaign,
the deadline will also drive, like when you're in the final, we have a countdown with seconds on the Wefunder page, as you know, and so when that's activated, that also spikes the return on ad spend. Deadlines always drive action, right?
Absolutely. By the way, what about Clubhouse? I've heard you guys have been very active on Clubhouse. Is that a viable tool for founders to be using? Are there a lot of investors on there or different partnerships to be had?
Yeah, I think so. I mean, there's a couple of clubs, I guess they're called, rooms maybe. I'm not sure what the right noun is. But so there's opportunities to, it's basically like a Shark Tank, where but people listening can actually just go onto the Wefunder campaign and invest. So it's much more kind of interactive. And so there'll be judges listening to founder pitch and asking questions. And then so I've seen those move the needle. There's one called Crowdhouse, which is really awesome. So that's the main use case I've seen for Clubhouse. I mean, I don't think there's the ability to advertise on there. So it's and it's still pretty early, but certainly looking for opportunities like that. And you mentioned like a webinar before, right?
Yep.
You could just, if you have a Clubhouse account, you could just start a room to talk about your Wefunder campaign, which actually I haven't seen anyone do yet. Normally it's just these like organized clubs, that might be a little bit weird. But I guess like if you're connected to hundreds of people on Clubhouse, then you could like ping them and invite them to hear you talk about your company. It'd certainly be an interesting experiment. I haven't heard of anyone do it yet.
Jonny Price recommends it. I've got it noted down. It's documented. We're going to put a note to Crowdhouse in the links below as well too.
Yeah, Chandra's awesome.
Yeah, but
yeah, it's an interesting platform. I think it's like a black hole. Like I've gone on there and then you wake up like 3 hours later. It's like, what did I just do with the last 3 hours? It's pretty dangerous. Probably like these social media platforms.
Yeah, I know a lot of speakers that are spending too much time there on a daily basis, but walking away with good things, and they'll end up with some big name on there. So it seems exciting for everybody. And I've always seen the value of being early in on a channel, being early in
exactly
on a new platform for ads or a new platform. I know Signal for some investor communications has been going very well, and Elon Musk mentioned them. Just to go back to your example. And, wanted to ask about optimizing. What happens when it is that situation where you can't pay people to invest, or, you're just not hitting the benchmarks you want, whether the cost per acquisition of ads is too high, whether there's just not much momentum, not much activity on the page as a whole. What could you tell founders to attempt to optimize in those discussions?
Yeah, so honestly, I probably wouldn't use that word at that point, right? I think like for me, optimization is if you're spending money, or if you're kind of implementing tactics and they're working, then you can tweak them and refine them, and take the ROAS from 6.2 to 6.8. For me, if it's really not working, well, first I think testing the waters will probably help to reduce the number of companies that are launching campaigns that shouldn't be launching campaigns because they don't yet have something that people want to invest in. So those companies, obviously, the ideal is they're not launching Wefunder campaigns, right? They're continuing to work on the product, or they're launching a Kickstarter campaign, or doing a Kiva loan, or whatever it is, and then coming back to raise 50K or more on equity crowdfunding when they're ready to. But for the companies that are live, and then it's like, well, we tried this and it's not working. Then for me, it's less optimization, it's more kind of iteration and experimentation. Okay. So I think the best founders, Maxime Tuchman from Caribou, who I think was the first Latina founder to raise $1 million on Reg CF, really impressive woman, brilliant founder, and she's a great example for me of she just hustled. And so, she was doing ads, sure, but she was, taking every phone call, emailing every person, getting on every podcast, every blog, reaching out to journalists, and it was just a relentless, barrage of energy and momentum and ideas, and brilliant ideas and good ideas, and then take the ones that are working for you and your audience and your community and your product, and doubling down on those. And obviously, for every and this is where you guys, I think, earn your money, right? It's like every company, every campaign, every founder, every situation is different, and so how do you create a campaign that's kind of going to work for you right now with your audience? And so, where you're finding the tactics that you're trying to employ are not working, then just keep on trying more tactics. And I think the best founders, right, are the ones that just like make it happen and find a way. And so I definitely think Wefunder is an easier way to raise capital than, trying to raise capital in a Reg D from accredited investors, or kind of routes outside of Wefunder, getting a bank loan, whatever the other options are. I do think it's easier, but it does take hustle and ability and skill and energy and drive and determination and time, etc., 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 all of those things. So it's certainly not like, you know, I mean, sometimes it is like lost spirits, it was super easy, but for the most part, most founders are, you know, as you know, it takes time and effort. And so just bringing your A game, just if it's not working, changing it up, you know,
Yep.
and, that's kind of what I would generally recommend. If founders are finding it's not working, just like keep experimenting, keep iterating. And then when you find the stuff that does start to work, that's when you kind of optimize, refine, and double down on that.
Yes, testing, iteration. We look at it for entrepreneurship, but in marketing, we'd never want to be the marketing group to come to the call and say, yeah, it's not working, we don't know what to do. Particularly because we've had groups that hadn't seen the best performance 3 weeks in, and by week 6, we're surpassing all the benchmarks they were looking to hit. So we try to come to the call with energy. We try to recommend generally one of 3 things: different audiences, different creatives, or different funnels to take them down. The funnels could be a different channel. It could be a landing page and first getting an email grab and then being able to engage them across multiple touch points. But we always want to have some new idea to test out, to iterate, as you're mentioning. And then that leads perfectly into the scaling conversation. So as we're talking about metrics for the week, we're able to say, hey, we are getting a 6.8x for this one ad set. We're optimizing towards it. We're going to put more budget. But looking at the audience size, we could scale. We could reach twice as many of these individuals the following week. I think scaling is going to be a big part of the conversation for 2021 with the expansion to 5 million here.
Yeah, 100%.
How have you seen some of the best campaigns on Wefunder scale to, you know, hit the full cap?
Yeah, it's a really good question. And obviously, you know, I mean, I guess Legion M have raised 10 million. We've raised 10 million on our own platform, but for the most part, we've been more focused on RegCF historically, and so companies have been limited to 1.07 million through RegCF, and then they could raise more through RegD, and so hence, you know, Grow Guru and Maersk, they're 2 examples that raised a couple of million last year. Detroit City Football Club is another cool one, but so we haven't had as much on the scale, I think, previously. I think, like, you know, I like what you said earlier, that the advertising channel is kind of a lever, right? You can scale that in a way that, like, if you do a webinar, right, it's like tougher to do another webinar, right? I guess you can try to put that webinar in front of more people, but you know, like, or having like an impact when everyone's back to in-person stuff post-COVID, like if you're a distillery and you can do a tasting event, you know, like scaling tasting events is like harder than scaling digital ad spend. So I think, but as well as ads, I think, like, again, it goes back to, like, the ideal, right, is that you can raise 5 million without any ad spend. That will be some sort of viral coefficient, right? So the ideal with scale is, I think, there's a viral coefficient, and I think the best way to do that would probably be to, you know, going back to what I said earlier, kind of leveraging the investors as they come in, right? So, you know, or like the 35 crack team that can, like, help with distribution of any content that you're posting that then gets in front of more people. But, you know, imagine if, like, every investor that you've brought in brought 2 more investors, because you surprise and delight every investor when they come in. Then they get, like, I don't know, 100 postcard of thank you from the CEO. Or if you're, like, you know, a candy company, then, like, you know, for an average investment of $1,000, costs, like, you know, $5 to send some candy in the mail to them. So what's that, like 0.5%? And so, you know, then that's like such a surprise and delight moment for the investor that they tell 5 other people to convert, and now your viral coefficient is over 1. And if you have a viral coefficient of over 1, sorry, probably shouldn't talk about viral coefficients in the middle of the pandemic, but you know, then you can scale in a very economical way. So those are probably the two approaches to scale, and the more you can do to improve that viral coefficient, I'm sure you help your clients all the time thinking about this, right? It's not just like ad spend, but it's also like the other kind of wealth of marketing tactics available to them. And so, yeah, trying to think how we can delight investors, how we can bring them in, how we can build a relationship with them, how we can get them super excited about, you know, what we're building here, so that they go and tell everyone else to invest. That's the magic formula, which obviously is very, very hard to get to.
Yeah, and I've never referred to myself as a viral coefficient expert, as you just laid out there. I love the numbers around it. We include that in our algorithms. So we'll talk about impressions to clicks to conversions, and use industry standards on how the visibility, the awareness produces an investor, an average investment. We now look at second investments and the percentage of investors who participate multiple times.
Man, that is the holy grail. If you can like, over time, like drive that viral coefficient up, then that's where the ROAS just explodes. Right?
Investor relations, we've seen that on Reg A Plus deals with clients where the issuer's team would give them a call, right? Automatically bring in $2,000 more, and that takes in Reg A Plus amounts, which
100%
much higher.
100%. Investor relations is a great one, right? Like if there's an investor put in, maybe it's above a certain amount, $1,000, $5,000. Jump on a call with them. Are you doing that with every investor? Jump on a call with them, and then maybe they increase it, or maybe they connect you to some other rich friends that can follow them.
Even a strategic partner. Anyone involved there. And that's all on top of the third that the portal, as you were saying, brings. So you're able to look at the viral coefficient all the way up. Awesome. Drop in knowledge. A lot of actionable insights here. And if anybody wanted to get in touch with you and learn more about a Wefunder campaign, more about investment crowdfunding, what's the preferred method to do so? Yeah,
I'm on LinkedIn, but I'm pretty bad at responding to LinkedIn messages. So I'm also on email at jonny@wefunder.com, JONNY @wefunder.com.
And we just want to see more success industry-wide. I know you are at the forefront of that campaign as well, too. So I appreciate you coming on here.
Thank you, man. And by the way, you might be about to say this, but if you mention the DNA connection, then we actually have a discount for founders through the referral partnership we have with you. So do you mention DNA if you reach out to me?
That's right. Mention DNA. Say you saw Jonny on a podcast here. For you audio listeners, he was wearing a blue Dodgers hat. Definitely not a Giants hat throughout the.
Come on, man. Let's be transparent here, Jason. I got my Giants hat on over here. Giants. No, I can't really claim to be an avid Giants fan. Like we were saying before, I'm more of a Lancashire fan when it comes to cricket, rather than a Giants fan when it comes to baseball. Growing up in the UK, but definitely not polluting my head with a blue Dodger.
But point that out to say, Jonny's very personal. He'll give you all the best recommendations. I've always, respected all the thought leadership you put on, and want to thank you again for being on here today.
Thanks for having me, man. This was a really fun conversation as always.
All right. Thanks, guys. We'll see you next time, and, keep on listening, keep testing, optimizing, and scaling. Take care.